to the extent capital of pension funds and insurance companies and endowments stay within the Eurozone with invested in Euro assets, the other part of this is the constraint imposed by the pension fund themselves. They would impose upon their investment managers not to switch the holdings to another currency because it takes exchange rate risk. Because when the day comes when these assets need to be sold to pay off their obligations in the euro, now they have taken on European currency risk. So basically, there were two fences that had to be hurdled by the European and private investors. They had the cash, they sold their bonds to the central bank, they had euro cash. Now they had two constraints to reach foreign markets like the US market that had higher yields, and the stock prices were doing, investments were doing better than in a depressed economy. So they had to leap both fences, so to speak. Well, about 20 years ago, the euro started to eliminate the capital outflow restrictions. In fact, in the last month, the Japanese central bank is going through the same thing because in Japan they have a government social security fund. The Japanese pension authority could only invest the assets of the savings of the Japanese in Japanese assets. They just changed the definition of domestic assets to include U.S. bonds as well. So basically, we're talking about the entire Social Security Fund of Japan now being able to access U.S. capital markets and get the 3% yields instead of the negative yields that exist in those countries. So basically, we have linked the markets. The capital is no longer trapped in the countries that are running easy monetary policy. So now, what does that do? Well, the seller of the asset in the first place to the central bank was like typically a pension fund. They now have cash in their own currency. They now have to translate that cash to another currency to buy assets elsewhere. It does have an exchange rate effect. If they decide the U.S. is the number one market where they want to invest, and they should be because our economy is doing better in terms of equities and in terms of debt, our interest rates were higher. So basically, we were the target investment country, and so basically they were shifting into dollars to buy assets here, which means in the foreign exchange markets in the past year, the dollar has appreciated quite a bit, so as a side effect. But then what do these folks do? They're looking for a substitute asset in the U.S. with a higher yield than what they could get in Europe or Japan, which is very easy because the yields are negative. So the search goes on for the alternative or replacement asset. What do they buy? Whatever their pension constraints allow them to buy, which would be the closest substitutes at first. Let's say the closest substitute to a Japanese bond or a German bond is a U.S. Treasury. Well, they did buy the Treasuries first. The prices rose. The interest rates came down. Then the second wave, they're now looking for something with more yield. So it would be the next closest substitute would be high quality U.S. corporate bonds. So those prices rise and the yields come down. Then the next one is looking for what is left that has not been already priced out. So the list of preferred substitute assets spreads out to something income producing. Well, it turns out it has spread out to, for example, dividend paying stocks, which means it's supporting our stock market. So to the extent our domestic investment managers are looking at the headlines and talking incessantly about the hopes and the fears of the U.S. economy, turns out the bigger issue is how much capital is going to flow in from foreign ports to be buying U.S. securities, because maybe as bad as our economy might be, which is not that bad, it's better than it is in Europe. And it's better than the low yields or the negative yields available there. So the buyers start to spread down to another tier of U.S. assets. Where is it spreading out now? Well, the most advantageous place right now that we're finding as an investor in the U.S., this gives us keys as U.S. investors what to be looking at. Well, the next asset that has not yet been heavily priced out is dividend paying stocks. And if it's not dividend-paying stocks, even what's better than that are dividend-paying preferred stocks, which get paid before common stock dividends. And we're finding, and those yields are 6 to 7% on average. So a whole lot higher yield than in the government treasury market. So basically we have invited the capital from Europe in through this mechanism. It is now a dominant force in the U.S. capital markets, buying all assets. Another asset they turn to, generating a yield or income, is U.S. real estate, commercial real estate in particular. And it's not only because that being a very well-behaved asset, in other words, appreciating, it's because the yields are higher, and also real estate can be more easily leveraged. And with today's low interest rates, we're getting even higher returns, leverage returns in real estate. So basically, U.S. assets are being supported. So here we are, where if you turn on the TV every day and see the list of all the things that are hanging over our head, all the gray clouds, what did Donald Trump say this week about China, et cetera, et cetera, et cetera. Basically, what they're missing totally is the world capital markets are shifting to U.S. assets. So the place to be for the least risk is U.S. assets. Basically, the game has changed. We all think of being Americans and being trained this way in college. And if you were not trained this way in college, all you have to do is read the news or turn on the TV, and what you hear from is a reporter who was trained, and they all think that lower interest rates in the United States come from our central bank. Well, it turns out the lower interest rates in the United States have been coming as a result of the easy monetary policy in Europe and Japan. For the first time, really, in financial history, the barriers between the capital markets have been reduced to almost nothing. And so the expansion of money in Japan and Europe in particular are now flowing into U.S. financial assets, purchasing those assets at a higher price, which knocks down the yield. So basically, we have asset price support. As I said at the top of this blog, this week we had a record high of the S&P index. We had a record high of NASDAQ. And as far as bonds are concerned, we have a record high price being paid per dollar of interest yield from a U.S. Treasury. We have the lowest interest rate in the history of the United States. That's 229 years. That's how the influence, and it's not because our central bank, as we're all taught in an Econ 1, 2, or 3 course, of which I taught for years, it's not due to our central bank, because they, for the last 3 years, have been tightening. They were net sellers, not buyers. So basically, we now have a worldwide integrated capital market, and the most expansionary central bank ends up calling the shots or calling the price and setting the yields worldwide. So as a U.S. investor in U.S. stocks, you now have to take account of that.